Within the current housing crisis, there isn't an absence of cheap or free money. There is an absence of leadership. Financial markets tend orderly or disorderly, largely as a function of uncertainty. Patient capital, that is, capital with an objective, can help order markets by making them more predictable. At this moment in time, our mistakes of the past have caught up with us in the present. Turning back the clock, in 2007, John and Jane Citizen purchased a new home. They used the then in vogue fashion of financing it with a first and second mortgage from two different institutions. More on that in a moment. John and Jane had a good combined income and found servicing both the first and second mortgages were within their capacity and within historical norms when we consider their total debt load. At the time they purchased the home, they had plenty of economic incentive and capacity to follow through on their obligations. Here we have laid out the original characteristics of John and Jane's purchase. A downloadable copy of this example and this paper are available under the Financial Solutions tab. John and Jane have played by the rules up till now. For 4 years, they've made all their payments on all outstanding debt in a timely manner. But now, with collapsing housing prices and a slower economy, the home is worth less than they owe on it. If they are able to find a short sale buyer, a complex transaction to push through these days, the current investors will lose about $23,000, a figure which wipes out the second lien holder, but exposes the first lien holder to the second's denial of a short sale that zeroes him out. In most cases these days, the two lien holders lean into each other, and the house is eventually repossessed and sold at auction, where investor losses could expand up to close to $65,000, simply because the current process makes them competitors rather than collaborators, and no amount of government encouragement will change this dynamic. Added to the investors' and borrowers' challenges is the fact that Jane and John's income has also been downsized in recent months, and they are now 1 month delinquent and not likely to be able to turn this situation around on their own. Here is where we use patient capital in the form of the hardest hit funds already awarded to state housing agencies to deal with the housing crisis, to do something smart for all involved. We acquired Jane and John's loan from the banks at book value, in this case, because we can see what they need and are willing to comply with is to have their debt and equity in the property adjusted to their capacity to pay. They want to stay in the house, and they are willing to collaborate with us in ways their current economic obligations simply won't allow. Working backwards from what they can afford to pay without being in over their heads, we break their challenge into 2 parts: a new first mortgage lien, and, secondly, a new contract that assigns property appreciation rights to the patient capital until such a time as when they can repurchase them. Not everyone is an ideal candidate for this scenario. In general, these are the types of borrowers investors hope will fix themselves, but more often than not, left to their ever-dwindling resources, they collapse and take everyone down with them. For this reason, and understanding that this type of scenario is conflicted, we will purchase these assets at book value simply to get them in an environment where time can help heal the problem. This helps the investors, borrowers, the neighborhood, and in the end, the taxpayer too. In this case, given John and Jane's negative equity, other debt obligations, their reduced capacity to pay, we need to reduce their principal, interest, tax, and insurance monthly payment to near $915 per month. Wanting to fairly compensate ourselves for the use of the patient capital, we will lend it to them at 6%, which implies a first mortgage balance of around $106,000. We will use this amount and $57,000 of patient capital to absorb the rest of the acquisition and restructuring costs. Embedded in John and Jane's problems are shorter-term, often more expensive obligations, which, when retired, can be used to repurchase the property appreciation rights they have granted us. As part of our program, we require borrowers to repurchase the fund's appreciation rights at levels designated to yield the fund a 6% return. As the first mortgage performs, we will eventually sell it into the capital markets to recycle these funds or return them to the federal program and the taxpayer. Thus, taking a conflicted business arrangement, removing it from the conflicted parties at a nominal, if any, loss, more than likely a gain when loss reserves are adjusted, We've reduced the shadow inventory of loans that must be sold in a market where there are not many buyers, adding stability, shrinking supply, further benefiting asset pricing power. And we get the borrower back on their feet in about 6 years if property appreciates at 2% per annum once stabilized. We've created earning assets rather than giveaways. We've enhanced the bank's capacity to lend in more productive areas. We've spared neighborhoods and the taxpayers from a disorderly market. More to come.